to our topic, what got us here, obviously we've heard this morning from a number of sources that there is an oversupply of vessels, moderate demand for vessels. The global economy is gloomy at best, and it looks like the outlook is not great for 2013, and people seem to be somewhat more optimistic about 2014. And our panel is being asked to explore the question of what public companies should do to recapitalize themselves under these circumstances, which is somewhat of an easy question, but it's not necessarily an easy answer. And I think we're going to be looking at more practical approaches, no crystal balls among the panelists, but this is really a practical question. What's going on today in the markets, and what can public companies do to recapitalize? While we've heard gentlemen say that the market's gloomy, but yet the capital markets do remain open. There are deals that are closing, but in general, pricing hasn't necessarily been optimal. And the capital markets are volatile and unpredictable as a result of world events and general economic conditions. So what do public companies need to do? Obviously, want to continue to build net asset value to the extent possible, build liquidity, have some strength in order to grow and take advantage of opportunities in the loan market. And I'm honored to share the podium with our panelists here, who are all top experts in tapping capital shipping. Notably, there are no owners on the panel, which I think is indicative of the fact that we really want to demonstrate what, from a banking, investment banking primarily, and fundraising point of view, what we can add to this conversation. And of course, all of our panelists are also heavily committed to the shipping industry. So on my right, David Frischkorn, who's a managing member of Global Hunter Securities, which is a very well-regarded boutique firm. You heard from Natasha earlier today. I thought gave a very nice introduction into her view of what the markets look like. Chris Weyers, sitting next to David, is managing director of investment banking at Stifel, Nicolaus, which is a very well-known investment banking firm in the United States. And he has been involved in the shipping industry for a whole ton of years. Next to Chris is Nathaniel Monclair, who represents New York Stock Exchange NYSE Euronext, specializing in international listings and covers shipping companies. Krista is next to Nathaniel, Krista Volpicelli, managing director of investment banking at Citibank's investment banking affiliate. Has been involved in numerous transactions involving shipping companies over the years as well. And finally, end of the road, Ted Jadek, the Managing Director, President, and CEO of DNB Markets. So, great panel, and I'm really looking forward to the conversation that we're about to have. So let's start off on equity. I'd like to hear a little bit from the panel, and maybe we can go down the line as to what we feel the availability is of funding in the equity capital markets. And maybe we can start with David. You can talk a little bit about the state of the capital markets and the type of funding that you've seen successful, and maybe what we can expect in terms of recap.
Good afternoon. The U.S. capital markets is what I'm going to try to address. Has been almost red hot in many, many industries, and be it energy, wherever, and is quite wide open, and both debt and equity, as you heard in the earlier panel talking about high yield. The high yield market is white hot, with single Bs in most industries selling like they were investment grade, and that was all addressed. It's absolutely white hot, and something our firm does. In the equity side, as it relates to shipping, the public equity companies have been recapitalizing themselves over the last 2 years. And there's been over 30 equity or quasi-equity offerings, including converts, that raised close to $2.5 billion in the last 2 years. And that's a pretty good number. And if you go back a decade ago, when is that there's been a lot of wealth destruction in the last 2 years. Depending on what sector you're in, even though in spite of this, we've raised $2.5 billion, many of the sectors are all in the last 2 years over 50%, with the big exception being gas. Gas is up 100%. At least on our index, it's a very small index of 4 companies. So I think the market is open. Obviously, you have to be of a certain size to address it, but if you want to do equity, it is there. It has been done. You saw Costamare do $100 million last week. That added another 100 to probably the 250 they have on their balance sheet. The week before, you saw Ship Finance do $100 million. So it can be done. It can be done overnight, and it's there and available. Thank you.
Chris? Yes, I guess I would add to David's comments. I agree for the well-capitalized shipping companies like Costamare, particularly those that pay dividend and can get sold retail. They have substantial availability of equity capital, but most shipping companies today have little to no access to equity capital. Most have leverage levels that are way too high for the current business to support, and they have covenant issues either with banks or other classes of security in their balance sheet that could make that capital effectively callable at any time. So equity being the most junior part of the capital structure doesn't want to come into these sorts of companies unless they know there's a substantial runway to get to what everybody knows will eventually be a recovery of the market. We just don't know when. So I guess my big comment on equity is yes, I agree it's available, but for most companies it requires substantial balance sheet work with existing liabilities, bank debt being the primary liability that needs to get addressed to build an efficient runway or an effective runway so new equity investors can see can see to a recovery and see to actually making a return on their investment. That's kind of, I think, been the challenge over the last 4 years since the financial crisis hit, is there's been a disconnect between what equity wants and what banks and other creditors want. And I think it's become more and more challenging as time has progressed. I think it's kind of reached kind of a precipice now where you see a lot of companies that are running out of cash and that need to financially restructure. And you do see a lot of smart investors, either current owners or private equity or existing public investors that recognize value and want to put equity in the company, but they need the right solution with their banks and other creditors before they put the capital to work. So at least from our perspective, from our practice, we've been spending most of our time working with companies, to infuse equity capital into them, but in conjunction with that, it's working with creditors and other stakeholders to build, a long-term solution. At Stifel, we're partnered with Miller Buckfire on the restructuring side. That's really where we focus. We also have a big retail practice as well. We're the 7th largest retail broker in the United States, and we will, put equity capital of shipping companies through our retail system. But, most companies, today aren't paying dividends and don't really qualify. But, for the Costamares, for the TKs, for, some of the Navios entities, I think, those companies can do equity just like they've, done in the past. But for most others, it's a little more complicated, solution needs to get in place.
Thank you, Chris. Nathaniel, perhaps you can address some of the IPO activity that we've seen in the last couple of years have been companies that were affiliated with concerns that were already public. For example, maybe you could talk about Diana Shipping, Diana Container Ships, and Paragon, and the box ships, where there was some commonality of either management or ownership structure. What are we seeing in terms of the availability of the IPO market? I know that you have some views on that you want to share with us.
In fact, I can only echo the comments made by David and Chris. It's from the NYC perspective, we operate in global markets, and so it's interesting to look at what's taken place place over the past few months. In fact, the IPO market is quite dynamic, especially in the US. That's very true. Maybe less relevant when it comes to Europe, even the recent large transaction from Talents and Direct Line in the UK. You might sense the market wants to reopen in Europe. It seems to be very conservative. So right now, everybody is clearly looking at the US when it comes to raising capital. And when I say everybody, I really mean everybody. You do have an increasing number of European companies, even smaller sized companies, that are really positioning themselves to tap the capital markets in the US. We've seen that recently with some software companies, tech companies out of the UK. You believe that UK companies now think that they would be better off tapping the capital market in the US. Same thing with Ireland. We've also seen a rice producer from India being able to list in the US and raise something like $100 million. It's not a big amount, but you believe that. I mean, rice producer out of India going to US to raise capital and actually find investors. And on the other hand, you've got very large companies. We saw Workday, a human resource software company, raising a lot of capital and pricing above the range. And since the IPO last week, share price is up in excess of 80%. So the market is here, definitely. That's the good news. The good news is also it's open to every type of companies from every size and every geography. But what's very true is that you do need a strong team, a strong product to sell. And when I mean product, I also mean the strategy and the people behind the strategy. So that's maybe something that we should all collectively learn from the past. People have to be maybe more focused on what they have to say and sell to the market. And investors are clearly more demanding when it comes to new projects. But my sense is that I'm very optimistic about what's going to happen in the next few years. Increasingly, companies will use the capital markets just because there is less financing available at the commercial banks.
Thanks, Daniel. Chris, what's your view on the availability of the equity capital markets for shipping? Maybe you can address follow-on offerings and that type of thing. I know that your firm's been heavily involved in follow-ons.
Sure, happy to address that. And I guess one comment just to add to the IPO discussion, because I think that in shipping in particular, the IPO markets have been there, but it absolutely echoes what's happening in the unfortunately, over the past couple of years, despite all of the great efforts of many of those in this room who continue to see their investors continue to participate in conferences, there hasn't really been the opportunity to go out and market and sell new shares and bring in new investors to the sector. And that's partially a function of they've lost a lot of money. But, we're spending a lot of time with investors. We're starting to feel sentiment turn, particularly in some of the stronger sectors. But I think, you look across at where valuations are, and it's really just a question of timing. I think that there is a lot of room for equity upside, and, so we're optimistic to see how that develops over the next 12 to 18 months.
Thanks, Krista. Ted, from your perspective, what are you seeing in the equity capital markets in terms of public companies recapitalizing, gaining access, and maybe you can address your view and what you see as to who the investors are and what they're searching for, and how that fits into a public company's plan.
Thank you, Rob. It's difficult to come up with much new commentary from my colleagues sitting here on that point. I think what I think is the most important element today to successfully raise new equity in the public market is offering a yield to primarily what is a retail investor base, as Krista said, for at least for follow-on issues. And that's a function of the underlying business model, and the MLPs are the ones that are structured in a way that will capture that demand in today's market environment. Let's not forget that interest rates are effectively zero, and the yield on these shares is attractive if one can assume that the underlying contracts are performing. So, again, the companies that have that kind of a profile are able to go back to the market and raise equity, and they have been doing that, and I think they're correct to do that. For companies that are more commodity-based shipping, and when I say that, I mean companies that have a more traditional profile on the employment side of some mix of spot and time charter cover. The markets have been too tough, and the investors don't have any conviction. They haven't had any conviction about the underlying fundamentals of the business to be willing to put more capital to work. Alongside of that has been the value destruction that has been occurring, and really gives very little incentive for at least the institutional investors to put money into that type of profile. We were involved with trying to take a company public on the Norwegian Stock Exchange in the summer. It was a tanker shipping company, crude oil shipping. We felt we had begun to see some appetite from investors that the bottom of the tanker cycle had possibly come or was shortly at hand. And we felt this company offered an interesting profile on the employment side, secured by an oil major. But at the end of the day, it failed. And we think it failed primarily because there was insufficient conviction among potential investors that we were really even close to the bottom of the tanker cycle. And in fact, while we felt that there was an argument to be made that the shares were being sold at a discount to the NAV, investors saw it differently. They felt that this would continue to fall further, and in fact, would probably be overpaying at the price range that the issue was being marketed.
Okay, Ted, thanks very much. I guess that leads into the topic of private equity. We spent a lot of time on the public equity capital markets. I'm just wondering whether private equity, we heard a lot about before, and there's still deals ongoing, but how much private equity money is really still available for shipping companies in order to recapitalize? And how can that fit in? How would a private equity investment fit into a public company's balance sheet? Maybe we can start on the back end first.
I guess I'll jump in. I actually think that we're having a lot of conversations with sponsors today who are actually starting to get closer to putting dollars at work. And I think, for a long time, private equity has swirled around the sector. It's been spoken about in other panels. I think there's a lot of reasons that makes it challenging for them to do so. But, to a large degree, when they do come in to earn the kinds of returns they want in sectors where, there is cyclicality in asset values, I think that they have to be very comfortable that they can earn those returns off of an asset play. And so it's having evidence of a recovery and you're not investing too soon. But I think that with existing public companies, we've seen several examples of sponsors partnering with public companies. Typically you see it as a side vehicle. I would say that, so far, and this is not really a surprise, the financial investment community has structured transactions in a way that the sponsor has the optionality on the exit. And so I think it remains to be seen how private equity really benefits public companies because, the private equity firms typically have the ability to take companies public on their own. They could merge them into existing public companies, but they retain a lot of optionality. But I do think that what it has provided in many cases is incremental capital for growth. It is not cheap capital, and I think it is highly dependent on finding individuals who work well together, and that's part of the reason why it has taken a long time, and there's still a lot of folks who say they have interest but haven't really put dollars behind that yet.
Thanks, Christy. If anyone else has a comment?
I agree with Krista's comments. We also are spending a lot of time with sponsors. They all started kicking the tires back in 2008 when they thought they were going to buy ships very cheap, and that didn't really come about. But a number of them have continued to follow the space, have spent more time with it, have become more familiar with it, kind of begin to have an understanding of how it works, the upsides and the downsides are. And I think it's evolved to the point where now there are more than firms with considerable amounts to invest who are definitely understanding that an upturn is nearby. And again, sector specific is looking for strong management teams to come in and co-invest with. They do typically like control, but I don't think that's not an absolute rule. They're very focused on issues like corporate governance and transparency, which you might well expect. And a lot of them are firms for which a shipping investment would represent a tangential investment to other investments they have, say, in the energy sector. And those are investments that they've made over the last couple of years. And so, again, that's probably spiked their interest a little bit more in understanding what's happening on the shipping side.
Ted, thanks. I'd like to turn our attention to debt markets at this point. David's firm has a side-by-side along with their equity capacity. They do have a pretty substantial debt capacity. Wondering what you folks at David are thinking about the equity capital, about the debt capital markets, and what is available from the public shipping companies. I heard high yield bonds mentioned in the last panel, whether or not that is something that is or is not open to shipping companies today.
The market, the high yield market is white hot, as has been said earlier. As it relates to shipping, you really got to be in a special situation to be able to utilize it. As many of you know, Navios has successfully used it. Ship Finance has used it. There have been others that have used it. Economy has used it for his company and also for rigs. And it is absolutely there. But what they're looking for is some of the same things that you see in some of the MLP investors. They're really looking for term, and meaning charter coverage. They want to know, their only upside is getting their money back plus interest. So they're very concerned about that. I would say in today's market, you may be able to be more aggressive on your loan to value, but they really look at that. And I would say in today's market, on a first lien type of deal, you may be able to do 70% loan to value. But they also want to see that it's 70% loan to value at the end of the term. Especially on some of the things that we've looked at, there is amortization, which you don't see mostly in the public deals. They really want to know they can get their money It's there. It is successfully there, especially in the oilfield service side. As you've seen in many of the rig companies have used it very, very successfully. John Frederickson's rig company just did a $5.5 billion deal in a very short period of time, unrated. So there is money out there, but what they liked about that was that most of the rigs had 6 years of employment on average, and size is very critical. If you want to do anything less than $150 million today, you're going to pay an illiquidity premium, and that can be significant. It may involve warrants of some kind, and as you go down to even smaller deals, privates, they can be done, but they get more and more expensive. The market's there. It's just very expensive money comparatively to banks that the shipping industry's had in the past, but it is there.
So you would say in terms of positioning, if you wanted to take advantage of that marketplace, really looking more for long-term charter coverage, that's something that may not be available on economically attractive terms, same in dry bulk or something like that today. So is there a way to reconcile that, do you think?
It's hard. We've looked at some dry bulk deals. Again, those are going to probably have a lot more amortization than it's going to look just like your bank. They're really going to want to see that, and as you heard earlier, you're looking at double digits for the most part, 10, 11, 12% interest plus principal payments, potentially at this point, unless you're a very large public company and it's really incremental to your capital structure, it's your main capital structure. You're looking at very tough terms, but there are plenty of people that are willing to discuss it.
I'd add maybe one comment on the debt markets. An area where we've been spending a fair amount of time is essentially capital market loans, which would effectively be a replacement to bank debt. It cannot get done together with bank debt because it would either take a first mortgage position in the ship similar to the banks. But the idea is it's similar to what we've done a lot of work on with aircraft finance and essentially using those sorts of investors in that sort of market to do secured first lien loans on ships. And the concept is you can, for a ship without charter coverage, a new ship or a close to new ship anyways, you can't really do this with older vessels. You could do 50, 60% advance rate. It could build in a cash flow sweep function as opposed to a mandatory amortization function. So the idea is, you're essentially paying interest only initially, but as soon as the market recovers, you start to generate cash flow, then you pay back principal, and you'd be doing it, at a fairly low advance rate on fairly low historical vessel values. So as you kind of play it out with investors, you can look at history and you can say, there's never been a time when Capesize has been worth less than 60% of what it's worth today. And since your loan amortizes the vessel cash flows, it makes for a good loan value at the end of the term as well. I don't think, my knowledge, I don't think any of those transactions have gotten done. But we spent a good amount of time kind of thinking about it and working on them, and we expect to take some things like that to market in the near future.
Well, that's interesting. Actually, thanks, Chris. Appreciate that. Maybe we just move on a little bit, speak, I think, somewhat about what a public company can do to, as we mentioned, we're going to segue into how do you position yourself as a public company in order to take advantage of these available sources of funding for recap, and generally raising money in the capital markets. Why don't we just start maybe down at the other end? Ted, I don't know whether you have any thoughts on that in terms of general positioning. You did mention yield, and I think you also, along with David, mentioned the ill of value destruction. So I guess you have to marry those kind of things. In the equity markets in particular, I suppose a lot of shipping companies today are trading below net asset value. Any equity deal might result in value destruction, so to speak. So what can a company do to get its story across, and how can those markets be tapped effectively at a price that is that you think is something that would be helpful?
Thanks.
No, it's a loaded question, right?
Look, I think any owner looks at where his share is trading relative to what he thinks the net asset value per share is, or what he thinks about raising stock. So if a company is above that threshold, it's a much easier decision. What's important, I think, is to be positioned to go. I think windows will open very quickly. I think we're in a macroeconomic environment that is very schizoid. It's risk on one day, and it seems to be risk off the next. So the windows can be very short for when you might actually get into the market. If you're a company that is trading below that asset value, what do you do to right that situation in order that you might be able to issue shares? Look, you can always go out and issue shares with existing shareholders, but I think, frankly, in markets like we're in today, when liquidity is so tight, credit markets are so poor, it probably behooves owners to do that and take a longer-term view. That obviously makes shareholders happy, but that's where the relationship with those shareholders and hopefully institutional shareholders, you can't have that dialogue with the retail shareholder. It's very important to be able to get across your plan for the company and your view about how to restore value. Other than that, what do you do to build a story? You have to create a more stable business model. Shipping, to me, needs more equity. That's the long and short of it. It needs to establish over time a more predictable trend in its earnings and show that it's better able to manage its earnings through the cycles that we know always come. To me, that means more equity. More equity opens up potentially the high yield market more readily. So that I think it's a longer term answer, but I think what's really absolutely.
Okay. This question is probably more for some of the other panelists, I suppose. But is it possible to have a growth story in light of the fact that we've heard today earlier some of the heard from some economists and others, and it seems like things are muddling along and we'll get any instant uptick in vessel values. That's probably going to come maybe at the end of 2013 or early into 2014. So it looks like we're pretty close to the bottom here. If so, can a growth story be something that is marketable to investors? Maybe you want to start with that. Is it possible? Is it even possible?
Again, thanks. The first IPO I ever did was a growth story in shipping. It was Stelmar. It actually sold at a discount to net asset value at the time because it had some contracts that really made you value the fleet at below charter-free value. And in the U.S. at that particular point in time, it was well received. It was not well received in Norway, which we went to first because we were selling below net asset value. 3.5 years later, or maybe it was 2.5, I can't remember now, that stock that was 11 was sold out in the mid-30s, with a 4-bagger on it. So the growth stories can work. In today's market, I don't think in shipping that there is a, quote, growth story per se. Obviously, there are new vessels that you can add, and you want to try to add them accretively, or at least at a price that you think that things will work out on. But there's no one clamoring in the institutional world at this point for growth.
Chris, you might want to add on to that.
Yeah, I was going to say I have a slightly different view because I think that there are growth stories in certain sectors such as gas, and that's supported by the fundamentals of the sector. And so absolutely growth stories are what we as bankers, I think, want to try to sell to investors because that's what they're fundamentally trying company to season new builds and develop things over time and use and basically drop those in. Now, that is a structured way of growing a particular company, but to some degree, as we talk about what works with investors, and investors don't typically like the cyclicality of shipping and the ups and downs, it's one way that can help to mitigate against that. But I think that growth is fundamentally all investors are really looking for. And, the challenge in shipping is that you have the cyclicality to deal with to offset that. But absolutely, those are the stories that will sell.
I just have one more question, really, that I was interested in, and this is more for Chris, I think. Use of proceeds. Is there, other than deleveraging, is there a use of proceeds that can be successfully marketed today? I mean, most of the deals that we see, essentially money is being raised to replace bank debt for a number of reasons, maybe covenant problems or maybe just general deleveraging. But is there an effective way to raise money for other purposes in today's market? What are you guys seeing in that regard?
As a general rule of thumb, and I think everybody at this panel would probably agree, when you go to raise money, you want to raise money to grow the business, not to be defensive about, having too much debt on the business. And I think most of the follow-ons that have gotten done have had use of proceeds to grow the business, not to repay bank debt. But in reality, a lot of us in the industry know that a lot of these companies have been over-levered, and they're raising this money in part to kind of bulletproof, their current positions as much as they are trying to grow the company. But if you want to sell equity and get, a price that you're going to be happy about, you really need to have the growth story built into it. That's why, again, if you do have substantial leverage issues, the better way to go about raising equity is to, reach an agreement with, your creditors, subject to the new equity coming in, that hopefully, benefits the creditors and benefits the, the growth story of the company, which is unfortunately what I think most shipping companies are.
Thanks, Chris.
Thank you, everyone. Any questions from the floor on capital markets and prospects for the year ahead? No? Rob and Pamela, thank you very much.